Okay, so there's a massive wealth transfer happening right now, and the source for this explainer calls it the biggest monetary shift in 50 years. What's happening is that this process is silently destroying the value of some assets, while at the same time enriching others. So today, we're going to break down the playbook that's being used so you can understand exactly what's going on behind the scenes.
All right, let's just dive right in. It all kicks off with a really strange statement. The US dollar had fallen 11% in just a single year, and the president at the time was asked about it. His response was, "The dollar is doing great." Now hold on. How can a falling currency possibly be a good thing? That one comment, that's the key to unlocking this entire story.
And that really brings us to this central question we're tackling today. Understanding the answer here is absolutely critical because, according to our source, this isn't just some random market wobble. No, this is a deliberate policy that's designed to transfer trillions of dollars from one group of people to another. To get why this is all happening, we have to start at the root of the problem: America's massive and, according to this analysis, pretty much unsolvable debt problem. I mean, the sheer scale of this debt is what forces the government's hand and really sets the stage for everything that comes next. Just take a moment and look at this number: $38 trillion. As of the source's recording, that's the US national debt. To put that into perspective, that's more than $100,000 for every single person in the country. A number this big is almost impossible to really wrap your head around, but it's the anchor that's weighing down the entire financial system. Let's break that down in a way we can all understand. The source makes this fantastic analogy. Imagine your family makes $100,000 a year, but you're carrying $126,000 in credit card debt. That's pretty much the exact situation the US government is in, with its debt sitting at 126% of its entire annual economic output, or GDP. The interest payments alone on that debt are over $3 billion every single day. Now, you might be thinking this sounds like some kind of fringe conspiracy theory, but listen to what Warren Buffett says. He's arguably the most successful investor in the world, and he points out that this is just a fundamental reality of how modern governments work. It's not a secret plot, it's just how the system is designed. Okay, let's see how this builds, because this isn't the first time we've seen something like this. Whenever major world powers get into a serious debt crisis, they almost always reach for the exact same playbook. History gives us a really clear blueprint for what's happening right now. And this slide just illustrates the pattern perfectly. Back in 1971, President Nixon cut the dollar's link to gold, basically because the US was running out of gold to back it up. And the result? Since that day, the dollar has lost 87% of its value. Then you fast forward to 1985, the world's 5 biggest economies get together at the Plaza Hotel, and they all intentionally agree to weaken the dollar to fix a trade imbalance. You see, a weaker dollar makes American exports cheaper and way more attractive to the rest of the world. It's a proven strategy. So this leads us to the core concept here: inflation by design. See, when you're facing a debt this massive, you really only have 3 options. 1, you can cut spending, but that's politically toxic. 2, you can just default on the debt, which would trigger a global economic collapse. Or there's a third path: a controlled devaluation. You make the debt you owe smaller by simply making the money it's paid back with worth less. It's the path of least resistance every time. And here it is. Here's the real consequence of that decision. This inflation by design creates a huge, silent transfer of wealth. It punishes one group of people and systematically rewards another. And it does all of this without ever passing a single law. So who wins and who loses in this whole game? Well, on the losing side, you've got people holding cash, bonds, or anyone living on a fixed salary. Think about it. If the dollar loses 11% of its value, your savings just lost 11% of their actual purchasing power. Poof, gone. On the winning side, that's the owners of assets: stocks, real estate, precious metals. Their value is priced in dollars, so as the dollar gets weaker, their price in dollars goes up. It's basically a hidden tax on savers and a subsidy for asset owners. The legendary investor Ray Dalio just nails the illusion perfectly with this quote. The stock market isn't necessarily booming because the economy is fundamentally incredible. A big part of it is that the very yardstick we use to measure it, the dollar, is shrinking. Okay, so this brings us to what our source is calling the new safe havens. In this kind of era, this age of devaluation, the traditional playbook of hiding out in cash or government bonds, it might not work anymore. In fact, it could be the exact opposite of what you'd want to do. The analysis points to large-cap US tech companies with global revenue as a really key asset class. Why? Well, 3 big reasons.
First, a weak dollar is a massive tailwind for them. When a company like Microsoft or Apple makes sales in euros or yen, those foreign currencies convert back into more dollars, which inflates their revenues. Second, they have pricing power. Companies aren't going to cancel their Microsoft licenses, they'll just pay the higher price. And third, they create their own scarcity through share buybacks, which reduces the number of shares out there and makes each one that's left more valuable.
And of course, we can't forget the classic safe havens. Precious metals like gold and silver, they're tangible, real assets with a finite supply. You simply can't print more of them. For centuries, they've been the go-to hedge against currency devaluation. And, as the source notes, institutional data is showing these huge multi-hundred-million-dollar trades on gold, which is a pretty clear signal that the big money is already moving in this direction. Okay, so let's tie this all together. Based on this whole analysis of a devaluing currency, how does a person actually navigate this monetary shift? Well, the source material lays out a very clear, very straightforward strategic framework.
Really, it all boils down to this. You own assets that benefit from a weak dollar and from inflation, and you avoid those that are hurt by it. So what does that mean in practice? It means owning things like global tech stocks and precious metals. And it means avoiding things with fixed dollar returns like long-term bonds, and definitely avoiding holding large amounts of cash, which is a guaranteed loser in this kind of environment.
Now, it's really crucial to understand this isn't going to happen overnight. The source projects a timeline where, in the short term, we should just expect continued market volatility. Then, in the medium term, the dollar's decline continues, and that real-world inflation you feel at the grocery store is going to be much higher than the official statistics. And then, in the long term, we could even see a totally new monetary system emerge, which would present a once-in-a-generation opportunity for people who are positioned in the right assets.
And this all brings us to a final, really thought-provoking question. We've walked through the mechanics of this great monetary shift, from a massive debt problem all the way to a deliberate policy of devaluation. The strategy, according to this analysis, is to own real assets that can't just be printed away. So as the very foundation of our money continues to change, it's really worth asking, what will wealth truly mean in the decade to come?